All right, everybody, welcome to ASAP Finance, the importance of a Roth IRA. I'm co-host Sam with my other co-host Kyle.
It's good to be here. Glad we're finally getting this started.
Yep.
This is our first episode, so just deal with this on the technicalities. You want to tell them about the podcast, what we're here for, what we're here to help everyone with?
Of course I do. So we're really just making this podcast to help you guys. We want to share some knowledge, some tips about how to manage your money, how to manage your time, how to set yourself up for the future. And we really just want to help out that younger generation and help you guys with that stuff that school didn't teach you.
Right. School, they really don't help you out. They don't set you up for the real world. You graduate high school and you can go straight to college and you're on your own. You might have to get student loans and it's hard to manage your money because they don't teach you that. And that's what we're here for. We're here to give you the tips. We're both college students ourselves. So we want to share the tips that we learned and hopefully we can learn from you guys as well and just get smarter in general. So you want to start it off with some investing myths for the viewers?
I would love to. So you guys have probably heard, this is kind of something that goes around, is that investing is risky. All right. This is not entirely true.
That's a myth.
It is a myth. That's actually why we have it under investing myths. So, it's the investor themselves. That's what they can make their investments risky. You can buy your Dogecoin, your Shiba Inu, your GameStop. I'm not hating on any of those investments, but they're obviously not safe investments. You got to invest in the overall stock market if you want a safe investment. An example of this is the S&P 500. It's the top 500 US companies. And we got a little chart of it right here. The last 100 years, you can see it's only gone up, and it's actually never been negative in a 20-year period, which is just crazy. And investing, it can literally be this simple. You just set up an account, you turn on some automatic deposits from your bank, and you turn on automatic buys, and boom, you're investing. But obviously, if you're not investing, you can have your money elsewhere, which might not be a good thing, Kyle.
It's probably not a good thing to have all your money. Where else would it be? A bank account, of course. That's where most people keep their savings, like their money just to spend. Well, first off, think about it. If you have your money in a bank account, you're more likely to spend it. You have your credit card, you have your debit card. If it's in your bank account, it's literally one swipe away from you spending that money on clothes, new shoes, or whatever. And vice versa, not vice versa. In the other scenario, you keep it you own a stock or an asset, and it's so hard to sell and get back. So you're less likely to spend that money. But bank accounts, they aren't good for you. They don't give you any interest. It's literally, how much did they give you a year or something? It's like 0.0%, 0.006 or something like that. It's literally nothing. You're going to get like 6 cents a year if you even have $1,000 in there. So it's really just important to don't put all your money in the bank account, but you do want to like balance it out. If you have like living expenses, like say like 3 to 6 months, keep that in a savings account just in case something does happen. If you lose your job or some emergency happens, you have that money just to fall back on, so you're safe, and it'll just result in making investing even less risky, even though it's not risky in the first place. But yeah, banks just use you to make a profit, so just keep the money that you need for an emergency, and other than that, just go invest. Put the rest of it in an investing account. And there's a little secret we have here on the show. So Sam's going to tell you about the little secret, I think.
Mm-hmm. Yeah, I'm going to tell you about it, but just a little slight correction here. You did call it a little secret, guys. This is the biggest secret you need to know.
My fault.
Okay. And this secret is called compound interest. All right. Compound interest. And, to help you visualize this, I want you to close your eyes and picture you're at the top of a slope. All right. Shout out Killington Resort. We were just there.
Beautiful place.
Yep. Beautiful place. No broken bones. I
fractured my collarbone for all y'all YouTube viewers. That's why I'm in a sling here. So anyway,
so you're at the top of a slope, right? And you got a snowball. Okay. Say you push the snowball down the hill. At first, the snowball is going to be rolling really slowly and it's going to be really small. But as it goes farther down the hill, it's going to get bigger and it's going to move faster. Okay, so that's the same concept that you can apply to investing, and that's what compound interest does for you. So, say you open an account at 19 years old and you have $0 invested. If you start investing $500 a month into, say, the S&P 500, you'd be averaging 8 to 12% annually. So 8 to 12% annually.
That doesn't sound like
Might
that
not
much.
sound like much, but in 40 years, when you're retired, you know how much that might be?
Don't tell me, Sam.
Make a quick guess.
Make a guess. 8 to 12% doesn't seem like, probably like 200,000, 300,000, six figures probably.
That's a good guess, but it's not even close, because after 40 years, you're looking at $2.65 million median value.
$2.65 million.
Yep. And that's what compound interest does for you. It stacks up, and as you get farther in your time period, it just goes up so much faster. So that's the power of investing.
That's literally the steps to a millionaire. We're giving the viewers how to be a millionaire.
But I mean, they might be a little confused, because they're like, how do I buy this S&P 500 or whatever else I want to buy?
You guys are probably wondering how the money actually grows. So we do have there's a few options, like on the safer side of what you can put your money in to grow. First off, ETFs are probably the most popular term. They're exchange traded funds. They're basically they're a group of stocks, or for example, the S&P 500, just the top 500 stocks, but there's also other sectors, like for example, like cannabis or world cloud computing. The ETFs, they make it safer. Instead of investing in one stock, you can invest in a group of stocks, which makes it less risky. Then there's also even less riskier asset, which are called mutual funds. Those are safer. And what I mean by safer is they don't have as possible great returns as ETFs or individual stocks might, but they're less likely to fall during a crash. So they'll be more consistent gains over time. And then also, you just want to make sure that you're balancing out as you get close to retirement. You don't want like all risk, like you don't want all ETFs like right before you're about to retire, because if something happens to the stock market and it falls 20% or 30% and you're about to retire, then you're out of a lot of money, especially 30% of 2.6 million. That's a lot of money. So you want to make sure that as you get more money in your accounts, you want to make sure that you're going to risk off assets just to be safe. And then there are also, for our younger generation, there are like targeted retirement years. So for example, FFIJX is a fund, and that targets a 2065 retirement. So for like me and Sam, that's probably when we're about to retire. As we get to that age, they will actually adjust your holdings in your account for you. So you buy the FFIJX, and as you get closer to 2065, there'll be less risky assets in that account for you. So you don't have to worry about changing it yourself, and you'll be set for retirement right when you retire. So the best retirement account, y'all are probably wondering, what is it, Sam? You want to tell them?
The best account, just ever is called the Roth IRA. You probably recognize this from the title of the episode. All right. The Roth IRA is literally a secret weapon that you might not even heard about before, because they don't teach us about it. The Roth IRA essentially allows you to contribute your post-tax income. Okay, so that means, you're working a job and you're making wages, or you're making a salary. You can invest that money into your Roth IRA, and you can withdraw it tax-free once you're 59 and a half. You heard me, tax-free. That means when you put it in, make your investments. When you're pulling it out, you don't have to pay taxes on what you made. So you can contribute $6,000 a year into your Roth IRA, which equates to about $500 a month. And if you had a job, or if you have a job, that might not be too much money, depending on your situation. You might have heard of 401k before. That's a traditional IRA, but it's a little different, because that's where you can contribute your pre-tax income. But when you withdraw it, you have to pay taxes, which is why we just love the Roth IRA.
Yeah, Roth IRA is beautiful, because so just to clarify, we're securing our tax rate basically by when we're young, and when we get paid, we know our taxes right now. So we're deferring our taxes. We're not deferring our taxes. The 401k would defer your taxes to a later time, which you're not sure what your taxes are going to be in 40 years. And most people, when they're young, they don't have as much income coming in, so their tax bracket is going to be lower when they're younger. And then as you get older, you might have a higher tax bracket, which could result you in paying more taxes if you do choose the 401k route, which is just why the Roth IRA is just the best retirement account, best account in general, to be honest. If you don't have a Roth IRA, open one up. But you guys are probably wondering, where do you open one up, right? Well, let's keep it simple. There's Charles Schwab, we have TD Ameritrade, Fidelity. It's not a big life choice. Just do your own research on which one that you preferably like. Just check out the software, just check out the website, which feels most comfortable to you. And then read the reviews and whatnot. Just watch YouTube. It's not a big choice. Just choose whatever you like, and then go open it up. Hop on, open your next tab, and type in Charles Schwab. We have a list right here for you with what they're best for. So you could hop on right now and open an account if you like. Right?
Exactly. Yeah. And I mean, you might be thinking, I don't know, like this sounds like it might take a lot of time and I'm a little lazy or I'm super busy. I mean, you can literally just hop on YouTube and look up how to set up my Roth IRA on TD Ameritrade, and boom, 10-minute video that'll walk you through it, and you won't make any wrong steps.
Right.
So it really can be that simple.
I mean, YouTube videos and podcasts, those are really the best,
especially podcasts.
Yeah, I heard ASAP Finance is a great podcast.
Definitely one you want to watch.
Definitely like #1 in the world. If you're not listening to it, you're probably losing money. So make sure you follow and subscribe to ASAP Finance, because I heard they're really good people over there. So you guys are probably wondering, there's probably some rules with this Roth IRA. It's not like it just instantly makes you a millionaire. So
rules, say rule, dude. This is our next slide. Okay, so I'm actually gonna read you guys some rules. So it's just important to remember that it has to be post-tax income you're contributing to your Roth IRA. So it can't be like savings or gifts. Say 1 year, it's your 20, it's the big 20 birthday. Grandma's feeling generous and she gives you $5,000. That $5,000 can't go to your Roth IRA.
I wish I had a grandma giving me $5,000.
Me too. So it's got to be money that you make from a job, wages, salaries that you contribute, and that can't exceed $6,000 per year. And if you do over contribute, like more than that $6,000, they'll penalize you and you'll have to pay it back. That number has gone up in the past. It used to be like 4,000 something, and Congress has been increasing it. So hopefully in the future, it keeps going up. I don't think we'd mind that.
Not at all.
And one last rule, you got to be 18 or older to open a Roth IRA.
Wait, do you?
Do we have an exception?
We do have an exception.
Oh my
we have
gosh.
Another secret of investing here.
This podcast is just full of secrets. Okay.
This is what we're here for. You do not need to be 18. If you're working and you're like 16 years old, you just get your first job and you're wondering like, I have a lot of money on my hands and I really want to save it. I want to set myself up for later. All you have to do is just go talk to your parent, talk to your mom or dad or your legal guardian, whoever can, and then you just go down to a broker, call them, hop on the website, and your parents will walk you through it, the setting up of the account, so you can start contributing money in, whether you're 16, working at Wendy's, or you're an 8-year-old or a 10-year-old at a lemonade stand. If you're really setting yourself up when you're that young, you're already a beautiful person. But yeah, this is the point. Every year counts. So from 18, 2 years is going to make a big difference in the long run. Like Sam was talking about compound interest. How much of 2 years is really going to make a difference?
2 years, it really doesn't sound like a lot. But I mean, looking back at this chart again, okay, you see at the end of the investing time period, it starts to go vertical. So an extra 2 years, like look at year 38. Okay, so if at that median 10%, you'd have $2.3 million. Okay. Even just one more year at 10%, that's another $230,000. So if you start investing 2 years earlier and you're making that 10%, then that's another $600,000 almost. So the earlier you start, like it pays off substantially.
Compound interest. That's the magic. You guys are probably wondering, it's a lot of information. What do I do? Like you guys are probably what do I do? This is what we're here for. We're here to set it up in 4 simple steps. Like I was saying before, all you have to do is call or visit a broker's website, ask them about opening an account. If you're under 18, just ask for your parent or your legal guardian, and they'll help you with it. So hop on a tab right now, do it. It will take you 15 minutes. Just hop on another tab, open up an account. It'll take you 15 minutes. It's the easiest thing you can do to set yourself up for your future. And then next, just make sure you do your own research. We aren't financial advisors, so make sure you do understand like what you're investing in. VU, like we said, BGT is also another good one. That's a tech ETF, which is more risky because growth can defer, right, Sam?
Yeah, and not only know what you're investing in, but you also just remember you're investing for the long run. So like dips and corrections, they happen. So you gotta it's hard at first, but you gotta just look at that and see it as an opportunity to keep buying and not panic.
Right. That's a great point. And then also we do have a VTI, which is a dividend ETF. The special thing about dividends is that say I buy VTI, I buy 1 share of VTI. No matter what, if I buy it at $200, whether the price goes up to $300 or the price goes down to $100, I'm still going to get a dividend just from owning that stock. So if you like seeing money come in consistently, dividend stocks are what's for you. It's also good to stay balanced. You don't want all dividends or you don't want all non-dividend stocks. So make sure you keep the right balance. And then third, just make sure you establish the amount you're willing to invest. Understand like how much money you're bringing in. And like Sam was saying in the previous slide, make sure you're following the rules. You don't want to contribute too much or contribute too less. I guess you can't really contribute too less, but just establish the amount, 10, 20% of your income, whatever you feel comfortable with. And then lastly, just start contributing and buy some stocks. Set up automatic purchases. Like Sam was saying, it's a long run game. If you set up automatic purchases and automatic transfers to your account, it'll help you from not looking at it like week to week or month to month. And you can maybe just look at it every year and you will see growth over the years in your account. So that's really all you have to do.
Exactly.
It's that simple. It's the magic of the Roth IRA and compound interest. It's a great account to have.
100%. And I'm sure you guys are wondering, like, wow, this is probably the best podcast I've ever heard.
That's what I'm thinking.
What can I expect in the future? Guys, this is literally what we're about to tell you.
We're not going anywhere, guys. We're not going anywhere.
We are not going anywhere but up the podcast. So, we're going to be uploading a lot more simple finance episodes, just like this one, where we, explore a topic, teach you guys about it, try and show you something that you might not have been taught before or in school. We're also going to try and secure some interviews with some cool people that we can learn from, that you guys can learn from. And that would just be a fun time having a podcast and an episode you guys might enjoy. Not to mention, we're looking for some special guests. So if you guys have anyone where you're like, man, my favorite podcast could definitely use this guy, just make sure you drop them in the comments on YouTube. We're looking for some big guests, aren't we, Kyle?
That's right. We are looking for some big guests. Shoot for put down the biggest name you guys want us to see on here, because it'll motivate us to reach that level and get the awareness from those bigger people, which is what we want to do, because we want to reach the biggest, brightest people in the world to have on our podcast so we can learn from them. And then you guys as listeners can learn from them. So you guys are probably wondering, where do you comment? Like, where are we commenting? If you're not on Spotify right now, where can we go?
Well, believe it or not, we're actually uploading this to YouTube. So you can just hop into our YouTube comments, and that will be our YouTube ASAP Finance. It's $AP Finance. We're also on TikTok, or we're also on Twitter, ASAP_finance. And of course, for the younger generation, we are on TikTok, ASAP Finance. We're going to be uploading a lot of clips on there and a lot of just informative videos. So if you're not coming from there, which if you are, we appreciate the support. But if you're not coming from there, make sure to go check us out. I know after this episode, I'm probably hopping right back on TikTok. So hopefully, if you are, you give us a follow right after you follow those action steps a couple slides ago.
TikTok, it's real hard. You get lost in TikTok just watching weird videos, but we're there to have informed. You're going to gain something out of our TikTok channel. It won't just be a laugh or a funny. You'll be able to gain something. It'll help you years down the line. So make sure you give us a follow and show support on those accounts, and comment what you guys want us to see. If we did a good job, if we stink, this was our first episode. So we're only getting better.
If you guys didn't enjoy this, I want you to rip us apart in the comments. Okay.
Seriously.
We don't want this to be some super boring thing. Although, we are throwing information at you. So we can't make it as entertaining as we'd like, but we don't want it to be something that you just hear and want to get over with.
And that's what I'm looking forward to with the interviews and the guests. That's going to be fun. We're going to have, hopefully there'll be someone different every other episode or every episode, where that brings in a new personality, and we'll be able to talk with them, and it'll be a different show basically every time, because it'll be new people.
Alrighty, guys. So like we said, the show is not financial advice. Make sure to do your own research and not take anything we say on the show as financial advice. Seek the help of a professional advisor if you need, and we will make sure to catch you on our next episode.
Yes, we
Thank
will.
you for the support.
All right.
All right. Stop recording.